Hello students, today we are going to start the leftover part of chapter Basic Concepts of Macroeconomics. In my previous two videos, I have explained you many concepts, and today we are going to start with the important concepts which are required for measurement of national income. First is gross investment, net investment and depreciation. Here it is important to understand the meaning of depreciation. Depreciation is the normal wear and tear, or we can say because of expected obsolescence or with passage of time, the value of machinery get reduced and we need to change it after a particular time span, which may be several years. Suppose it is applicable on all the assets, say machinery, land and building, but we will take the example of machinery here. So suppose we have purchased a machinery and we have paid particular price of that, which is called as purchase price of the machinery. This investment which we have made in purchasing that capital stock, that is the machinery, that particular amount which is paid for its purchase, it's called as gross investment. So while calculating national income, we need to understand that gross investment is the addition to stock of capital before allowing depreciation. We have not allowed any depreciation on it. This is the purchase price. After utilizing the machinery for several years, say we can take example 4 years. If we have utilized the machinery for 4 years, there will be normal wear and tear of such machinery, or it may happen that new technology get introduced, so there is obsolescence of machinery. So then we need to depreciate the machinery with a particular amount. When we reduce this amount from the purchase price, we call it net investment. Now when we have utilized this machinery for 4 years and suppose it was purchased for 1 lakh rupees. So 1 lakh will be divided by 4, and in these 4 years per year depreciation we can calculate, that comes to 25,000, and 25,000 will be reduced every year. So net investment is the actual addition made to stock during an year. We are talking about an year here because we are depreciating it every year. So net investment is when we will reduce a particular amount of depreciation out of this gross investment. So depreciation is gross value of a particular asset minus net value of asset. So this is the concept of depreciation. Second is the concept of net indirect taxes. Here, to understand this concept, we should understand what is the meaning of indirect taxes and what is the meaning of subsidies, because these two are the important terms which are to be applied to arrive at net indirect taxes. Indirect taxes. Indirect taxes are the taxes imposed by government on production and sale. It means the activities where production process is involved or selling process is involved, GST is imposed by the government. Suppose after producing some units in a firm, the taxes imposed by government are 10%. And the costing, that is cost of production of producing one unit, is ₹5, and 10% taxes are imposed, that is 0.5. So the cost of the good, means the market price of the good, is now coming to 5.5 rupees. This is the meaning of indirect taxes, which ultimately increase or is added to the factor cost. Factor cost means the cost of production at which the goods are produced, and by this, by adding these, we arrive at the market price. Next is the subsidies. Subsidies are just inverse to indirect taxes. Subsidies are actually the economic assistance, or we can say the assistance which is given by the government to the people or the firms. It may be given to the people, that is to the household sector as well as to the firm sector. The best example we can take for household sector subsidy is subsidies granted on the gas cylinders we use at home, that is the domestic gas cylinder. So, economic assistance given by government to firms as well as households for general welfare is called as subsidies. Now, see, the indirect taxes are imposed by government, but subsidies are granted by government. It means that suppose production of a unit is rupees 5, as I have taken example earlier, the market price was coming to 5.5 if 10% indirect taxes are imposed. But if government grants subsidy of 10%, the market price of the product will be 4.5 rupees. So here government is giving economic assistance so that each and every person of the community or of the general public, that is country, can avail these facilities which is ultimately for the benefit of the general public. Subsidies are granted to promote exports also, or to encourage such industries which are to be established in backward regions. This is done so to promote such industries so that that particular area can ultimately get developed. So, as indirect taxes and subsidies are inverse of each other, to arrive at net indirect taxes, we need to deduct indirect taxes from subsidies. This I have explained here. Indirect taxes minus subsidies is equal to net indirect taxes. Here we are required to include one more concept, that is concept of factor cost and market price. As I have explained you, factor cost means the amount which is paid to the factors of production for producing particular units, and market price is actually the selling price of those units. So, in factor cost, when we will add net indirect taxes, we will arrive at market price. So, difference between market price and factor cost is NIT. This has also been explained to you. Third concept is net factor income from abroad. Now, in my first video related to this chapter, I have explained you the concept of domestic territory. Domestic territory means not only the geographical boundaries, but it also includes a few individuals or activities which are located or established outside the country, but they are owned, controlled and managed by our country. So, definitely the income is also coming inside, that is there is inflow of income, same way there is outflow of income. When inflow of income is there, it means the income earned by normal residents from rest of the world, that income is ultimately coming to our country. So, it is called as factor income from abroad. Same way, if the factor income is paid to the residents of other countries which are located in our country, suppose, then that income is sent abroad by them, or we can say to rest of the world. So, this concept is called as factor income to abroad. Here it is important to note that we will consider only the factor incomes here, not the transfer incomes. So, net factor income from abroad is equal to factor income from abroad minus factor income to abroad. So, here this will be important when we will try to understand the concept of domestic income and national income. National income includes factor income from abroad, but domestic income does not include factor income from net factor income from abroad. So, when we will deduct net factor income from abroad from national income, we will arrive at domestic income, or in other way we can say that when we will add net factor income from abroad to domestic income, we will arrive at national income. So here these three concepts we have read which are important in arriving at a particular aggregate which we will study in the next chapter, that is through the next video, that there are 8 aggregates in the economy. First is depreciation. When net value is deducted from gross value, the differentiation of both is called as depreciation. Next is the concept of net and indirect taxes. Net indirect taxes means indirect taxes minus subsidies and the difference between market price and factor cost. And third thing we have read today is net factor income from abroad. Net factor income from abroad means factor income from abroad minus factor income to abroad, where there is application of domestic territory concept again.